What's going on, guys? Welcome into today's episode of Money Moves. I am your host, Matty A. My co-host, Mr. Brian Breedwell.
What up, guys?
What it do, brother? We cover all things stocks, real estate, investing, and personal finance on this episode of Millionaire Mindcast to help you on your journey to a million and beyond. Everything from world news, economics, and of course, what's going on in the financial markets and the real estate market. We got some great updates for you guys in today's show. Big news on CPI and inflation. We'll get the stock market's reaction. We'll get Mr. Breedwell's reaction. We will get the National Association of Realtors reaction and how that ties into rates in the housing market. We've got some thoughts and some feedback coming in from Mr. Breedwell on his biggest concern that he's paying attention to in the market right now and why it matters to you. Big news for Airbnb this week and how that ties into all of my hospitality and short-term rental investors. Google's big AI mishap and how that impacted their stock and how they potentially can recover. We'll be talking about Ray Dalio's thoughts around cash. Should you be sitting in his cash trash or should you be holding the bag and seeing some dry powder? That is all to be covered in today's episode. First and foremost, how was the Super Bowl?
Super Bowl was good. I had a fun time, made some beer cheese, hung out at the house, just watched the game, and had a chill evening.
Who were you rooting for?
Kansas City.
KC.
Yep, so I got what I wanted.
Being a Niners fan, it's hard to root for the team that beats you. That some people are like, no, you root for the team that beats you because you want to see it all the way through. But I was rooting for my man Travis Kelce and KC as well. My grandma, who passed away this year, is a KC fan, so I was stoked for her. $16 billion in bets. According to DraftKings. That was this was the first year you could legally nationwide bet on the Super Bowl. Yep. $16 billion in bets. A lot of the conspiracy theorists out there that were upset about that holding call at the end of regulation that really kind of solidified it for Kansas City.
Yeah.
As they start digging into more of these bets, the majority of the bets for the winner of the Super Bowl was on the Eagles. So some people, of course, are speculating if there was some funny business going on there with the refs. But, man, that was a fun game.
Yeah, and I think that a lot of people put the money on the Eagles because that one picture that leaked, it was like the Eagles are winning 37-34, and it ended up being
pretty damn close.
Kansas City won 37-34.
That was crazy.
Yeah, we got the USFL starting in like 8 weeks. Did you hear about that?
What, is that the Rocks League or no?
No,
or is that like a new league?
We got a new league, but it's like the minor league feeder for the NFL, and they're going to put it on live TV, and it's in the off season. But there's they have some serious players that are not like the backup quarterbacks. They go and they start in that league. So it's a way for them to actually get touches and stuff, and obviously they can generate revenue.
So kind of like baseball, basketball, D-League,
It's going to be, I think, a B league, and I think it's the only B league that's like directly affiliated with the NFL.
Love it.
Yeah.
More football. I'm always down for more football. Of course, we've had some interesting stuff go on worldwide with balloons and all kinds of UFOs and UAPs, unidentified aircraft phenomenons is what they're calling those.
Couldn't tell.
Being shot down 4 in the last 10 days. And a lot of people were saying, hey, what's going on? Like the administration's got to share something. Are we being attacked right now? As you hear all these crazy stories roll out on social media. And essentially what the now government administration has said is, because of what happened with China, now they've kind of expanded their monitoring and they're looking for more stuff, hence they're finding more stuff. But a lot of people still feel like it might be a smokescreen and they're just trying to get people a little bit more distracted as we have this big Ohio train crash that was a big fire.
Seems pretty terrible.
100-mile radius. You got people getting sick. You got animals dying. It's potentially one of the largest climate issues and hazardous, natural hazardous issues in the world since Chernobyl. Of course, the media is not talking about that. Of course, our climate, I think what's the word for them? The climate, the people that are really obviously, getting out there and shouting from the rooftops about climate change and being upset about it are nowhere to be seen or covering this story. So that's always interesting
Not
to
even
me.
covering the Nord Stream pipeline story as well, because I think they essentially found enough data to say that Biden administration ordered the explosions and attack on the Nord Stream pipeline to try to frame it on Russia so they could escalate the arms being sent to Ukraine.
Man, again, all of that sounds so conspiracy theorish, right? And yet, as you start to see things play out, more data comes out, a lot of this stuff is not as unbased as many people want to claim it to be. Ghislaine Maxwell court documents are to be unsealed this week relating to Jeffrey Epstein. Supposedly, they're going to it's going to reveal 167 names of people that were basically addressed or named over the course of the court case. I saw somebody joking around about it of if there was the majority of Republicans on that list, it would have already been published and they would have been covering it. So that's going to be really interesting. But it's feels like a lot of tension going on right now, globally, nationally, a lot of division. I guess this is something that we continue to be more and more accustomed to. But we're going to talk about how some of this stuff, and of course the data that was released this week, more importantly, ties into your finances. Today is, what 14th. Is it? We got the Valentine's Day. Special day. Love is in the air. And we're going to make some love to your money-making goals in today's episode. I like that. So, biggest news today was CPI. Inflation.
It came in as expected.
So, based on...
What the heck is all this stuff I'm seeing that is missed?
Forecast was 6.2.
No, it was not.
It wasn't. So, no, It was
6.5 headline, 6.4 core, and it came in at 6.5 headline and 6.4 core.
Okay.
Bank consensus, which is not a data point. It's an opinion. It's almost like our opinion.
Right.
They asked I think it's the 7 largest banks what their estimate was for what it was to be, and it came out to average 6.2. That is not an official. If you go into FinViz and you go look at the official reports, it'll tell you it came out on par. So that's incorrect information.
Yeah,
I don't know why. This is when I was getting mad that you notice I was getting upset last year when the media was harping on headline, and then they conveniently switched over to core after I had been harping on that is more important than this. And I talked about OER. Then OER came into the news. Now I'm telling you that rate cuts are the way they're supposed to be. That starts to happen. Told you recession is probably not going to happen. I've been saying that for 8 months. Now they're saying recession is, if there is going to be a recession, it's likely going to be very shallow and mild. There's a lot better data than what the news gives you. And that's, again, where I have my team, and that's what they do, and that's the data they crunch and send to me. And that's why we love them. They're saying, though, now, based on the CPI that came in today, because it hit, even though it is another month-over-month decline and a year-over-year decline as well, they're thinking that this brings that 50-50 more so back into the table for a potential for another rate hike of 25 basis points. The bond market is torn because I saw the yields go up with the stock market kind of going up as well a little bit today, especially on the NASDAQ, some more of our tech-heavy friends. That is not the movement you necessarily want to see. It's not indicative of something terrible, but it's not the movement that we want to see.
So is that kind of one of your biggest concerns that you're paying attention to right now, is this 10-year...
2-year, 10-year spread, and then I'm really just looking at the 10-year, because what I want to see is when bond yields go down, I want to see the lower end yields going down more than the yields on the higher end. So I want the 30-year yield to be dropping by 0.5%, and I want the 2-year to be going down by 2%, right?
Yep.
That way the yield curve starts to get flattened and back in line of where it's supposed to be, where longer-term debt pays more than shorter-term debt, and that's how it should be. I think what's going to continue to happen, we're probably going to get some CPI reports that are reported that they're going to be higher, but they're actually in line. Remember, this is the first year where we're doing a 1-year look back versus a 2-year chained look back. So that's going to help the data. It's convenient on timing, I agree, but that's the timing is what it is. I would anticipate that once we get through June, we're going to see aggressive negative numbers on CPI. Negative, like big time. Hey, it's expected to be 0.5 and it's minus 1.2. So we're going to see stuff like that probably coming around the July time. And then that's why I'm saying maybe if that continues to happen, that'll let the Fed say, okay, now we're way ahead. You know, we're too far ahead on our skis and we're going to fall forward and cause a melt up if we don't cut interest rates. So now let's cut interest rates. I'm still in that camp towards the end of the year, regardless of if they raise by 25 or they pause on the next meeting. And I'm hoping that they pause. But I was really hoping for a 6.3, a 0.3 print today on the core. That would have probably sent the stock market up by like 2.5%, 3.5%, and put a nice little catalyst in through the end of the week. But you don't always get what you want in the stock market.
Don't always get what you want. Well, National Association of Realtors chief economist Lawrence Yun kind of came out with their formal response and instant reaction to CPI data. The stubbornly high and rising rents are keeping consumer prices elevated. We've been talking about that, right? Of just the cost of housing being...
The shelter rate is an issue right now because it's skewing data.
Exactly.
Yeah.
The Federal Reserve, therefore, cannot yet relax on its monetary tightening policy. Mortgage rates could linger at around 6.5% for a few more months before heading below 6% by summer and maybe even 5.5% by the end of the year. Specifically, in January, tenants of apartment and single-family homes paid 8.6% more in rents this year versus 12 months ago. Moreover, the monthly change was 0.7 or 8.8% on an annualized basis. That was a big contributor to the overall consumer price inflation, running at 6.4% and well above the comfort level of 2% inflation. But rent relief is on the way. Apartment construction activity is at a 40-year high. As these new empty units steadily reach the market, rent growth will tame down. That will also pull back the overall consumer price inflation, right? With that number really being a big inflator of the overall number that is being read.
And building permits is for commercial, and that's not SFRs. That's actually apartments and condos, right?
Yes.
Okay, so, and that's why I was saying on Thursday, the building permit housing starts come out. I could care less about housing starts. I want to see building permits get caught up so I can get that rent, not rent control. I want y'all to make lots of money on your rentals. But when rent continuously goes up and it squeezes people, they can't spend their money elsewhere. And we want them to spend money in other places too. We don't want to be so greedy.
So to wrap up on Lawrence Yun's statement, what is needed in addition to active apartment construction is the building of single-family homes. There are not many listings of homes for sale.
I don't agree with that.
As mortgage rates dip in the future months, buyers will return, but without supply, another revival of multiple bidding could occur, which a lot of people are already kind of stating. The fact that inventory is still remaining as low as it is.
We don't need people buying houses right now, though. That's the other thing. And we don't need people don't need to be buying or selling their houses right now. That's not going to help or really even hurt the real estate market. What people need to do is
I still think it's a necessary part of the market, right? I mean, just like
I think there needs to be
like consistency is necessary evil of your side of the market.
Correct.
Same
but sometimes
as on the real estate side too.
Sometimes
you don't want to.
Sometimes we shift to different sectors though, and I think the sector in housing that needs to be more focused on right now is going to be commercial apartments. I really don't think how is it more efficient for us to get somebody and tighten their monthly budget, you know, like my neighbor, right? If you were to buy the house next to my house and I had the equivalent house and I bought it 2 years ago, you're paying double the mortgage. So to me, that's 50% more that can be spent less elsewhere versus rents are a lot more affordable. People can use them to transition into housing. And that also allows for a refinance on some of those mortgage rates to happen. I'm looking for more a refi boom than I am
But there's still a significant amount of equity that's getting unlocked that becomes disposable income to be distributed elsewhere in the economic marketplace, right?
Correct. But when you unlock it and you have to re-leverage and you're re-leveraging at 2 to 3 times the rate that you were, that's where
you're not always going to get people that redeploy that into home ownership though too.
Correct. Which is why I'm saying to my other point, apartments are important because they can hold on to that money and wait. Or people that got I think if there's an opportunity to buy now, you should not wait because you're in a buyer's market, right? Buyer's markets are uncomfortable for both parties, but it's the way you're going to get the best deal because you have leverage of being the transaction goer. Somebody wants to sell their house, they just have to meet your terms. I think there's a lot of new houses that are not coming available yet. There's been some pause in construction for seasonality. I think they're going to finish those up. They're going to hit the market here in the summertime. I don't think we're getting back up to we're going to have a shortage again, which I think is going to be a healthy shortage. And I think we should probably catch up next year as far as inventory being where it needs to be. I think that's going to be a 2024 story. I have.
Yeah, inventory is still extremely
there's
low.
No way
decreased
we're catching up.
3% week over week.
Yeah.
If you look at, let's see here, inventory was up 78% compared to the same week in 2022.
Which is good.
But it's down 45% compared to the same week in 2019. So
we just broke over half about a month or two ago, right?
Yeah, I mean, we're still practically 50%.
I think that's good, though, because I think what that does is imagine this. Imagine an inventory boom, right? So interest rates start going down, so builder activity goes up. Great for the stock prices, great for people that are going to buy homes. Now you have interest rates going down and houses being finished. They can finish a house in 6 to 8 months if they need to on track, right?
Mm-hmm.
You have all these people getting into the market at better interest rates, buying houses at a better price, getting interest rates at a better price, and then they're getting into those houses, and then they're buying products for those houses that drive into our, consumer discretionary, consumer defensive. You're talking about Target, we're talking about Kroger, we're talking about Kimberly-Clark for your home. That's what buying a home does, and you want people to buy houses in a healthier interest rate environment, in my opinion, than see more people buy houses in a less healthy interest rate environment because it tightens cash flow.
Yeah, sure.
That's where the only concern for me is if we have a housing boom, but interest rates do stay higher than normal for longer, we're talking 5.5%. That's a big deal. $300-$400 a month is a big deal to some people.
Yeah. Key will be when inventory starts increasing in 2023 because we really haven't seen that. A lot of people have been talking about it, right? We're going to see, the market pull back in terms of, values and of demand. The thing is, all of this is really driven. I mean, demand is being
I see fall
curbed.
Starting. I think fall is when you're going to start to see a drastic curve up, and then
I think it's going to be towards the end of the year because
it's kind of like when interest rates.
Obviously, inventory bottoms out usually in February or March every year, and then starts to creep back up throughout the year based on seasonality. So far, inventory has declined almost 10%, 9.7% over the first 6 weeks of 2023. That's pretty staggering.
Do you think that has something to do with the fact that we had that dip in interest rates back down around the 5.5% zone there for a few weeks? And so some
absolutely. I mean, most of the mortgage brokers that I talk to that I know are big players doing relative volume, and then obviously keeping up with mortgagenews.com. Every time there's any little bit of relief in mortgage rates dropping, people are getting back off the fence and feeling like this is their opportunity, and you're starting to see some multiple bidding on certain products, certain markets. That being said, we're not talking like what we saw 12 months ago when things were insane, multiple bidding wars, 2050, $7,500, $1,000 over asking. But at the same time, there still is a heavy amount of demand where we've got a lot of dry powder, still a decent amount of, equity that still needs to get absorbed into the marketplace. Yep. And the people that, were maybe on the fence when they see a little glimmer of hope, and with the market being where it's at right now, they're
striking
jumping
while
back
the
in.
iron's hot.
Yeah, they're getting back in the game.
Especially on these new builds.
So that's going to be interesting to kind of see how this all ties out or ties into, what actual dips we see in terms of home values in the Case-Shiller, price index. Because if it kind of stays the way it is right now, until we see a massive drop in, rates, until we see a big uptick in supply, it could remain relatively steady through, 2023.
I would love to be wrong about the pricing of houses going down. I think they've already adjusted, a few single-digit percentages down, but nothing like what I was anticipating or even we were talking about at the beginning of the year. I think the market surprised everybody being better than it had been anticipated. The January effect obviously was a little bit in for the stock market, and we're seeing that fizzle out here a little bit in February, but it's better than expected, which is good news for everybody.
Yeah, I mean, Tone, if you pull up the Realtor.com graph on newly listed homes, from this year to last year, new listed homes are down 5.4%.
But the craziest thing is, if you look at it,
I mean, so that data point down there at the bottom is the beginning of 2023. And where you look at, all the remaining years of where they started, 2023 is significantly lower than 22, 21, 20, 19, 18, 17. And obviously,
all move
as the
fairly
year
in lockstep.
they do as the year, as you go into our spring and summer months.
Like you would expect then, if this was going to be a graph that would, you would expect to see a sharp uptick in the early and then kind of a sharp decline in the back end, right?
Yeah.
I think I'm on par with that as well.
So the fact that it's already starting much lower, the question becomes is if it does stay within the same trend, are we still going to end the year at relatively low inventory of newly listed homes? Or are we going to see, that graph? Because if you look at 2020, right, it was going up seasonally the way it should have. Boom. Well, what happened in March, April, and May? Bam. Big drop down. That's the only inversion you see on this graph. Otherwise, they all, like you said, kind of flow in lockstep and, peak out around summertime and then slowly
Especially
start
17 through 19. I mean, they were like...
Yep.
I mean, look at the starting points. They're all within 20,000 houses.
So I just think it's interesting to see how how this year is starting out at an already, tight inventory, and the fact that it's well below what other healthy levels of inventory looked like in previous years, and we know how those years played out. It's going to be very interesting to see how, this year plays out, and if we see the trend go up, or, in this April, May timeframe, if we really start to see, newly listed homes continue to stay off the market because people don't feel like they have any options to, exchange into or buy into, or, if they're going to get the values that they want, or if it even makes sense based on where rates are at.
Yeah.
So
no, I'm seeing a lot more people on the buy and hold for rentals now because of where rent prices are. And I think, where it was an A and B class market, you can even dip your toe into the C class market a bit and get some good cash flow.
So still TBD. So make sure you guys stay tuned. We'll be tracking all the data on that. Big news for Airbnb.
Huge.
They just posted
almost 100% beat on their EPS.
Their very first.
Nope, that's Palantir.
Was it?
Yep.
I thought it was Airbnb's first year of positive earnings.
No, that was Palantir. You just jumped ahead.
Oh, I got excited.
It's okay. Palantir's up a shitload too. Airbnb reported an earnings per share beat on, I think it was 48 cents to 25 cents expected, and that's like a holy crap beat on earnings per share. That's almost double. Gave positive forward guidance. I haven't heard the earnings call, which is probably going on right about now, but I haven't heard that. But gave positive guidance for the quarters ahead, which they're one of the first tech companies that was not profitable and had historically not been profitable to now be profitable and start giving positive guidance, which I see the article up saying, Airbnbust.
Yeah, pull that up, Tone. Let's because I'm curious of Airbnb has had a ton of adoption. It's created a ton of opportunity in terms of an investment perspective, and what we're seeing in this is just one example. This was a guy that owns 95 Airbnbs in Phoenix and Scottsdale, which is where the Super Bowl was hosted, and he said over half of those were vacant, and he was slashing his prices 50% to try and get people in, and still was unable to do so.
Yeah, the teams are from kind of far away, dude.
So one of the things, he said market data suggests that increasing number of Airbnbs has outpaced traveler demand. I still think that is more of a speculation and an assumption than real data supports at the moment, because that could really tie into so many people getting fired up about Airbnb. They got their stuff on the platforms. The platform is collecting more fees. Obviously, travel has been relatively strong and stable over the course of the last few years through the pandemic, but maybe softening up a little bit based on what data is showing. Specifically in what my thoughts are is these suburban markets where, people are trying to turn their house in a neighborhood that not a ton of demand or destination is
built into it.
Is built into it.
There's not great anchors around it.
Whereas, let's say my stuff up in Tahoe, that's a leisure market that's got people coming to it year round all the time. Those Airbnbs, I think, are strong, stable, and insulated. Then you got the urban markets and cores,
urban markets,
that maybe have
suburbs,
the midterm,
especially.
traveler, traveling nurse, person for business, somebody coming in for a concert, not necessarily going on a long vacation, but, the short-term type of stuff, in and out. Urban markets, I still think in certain markets are going to be stable, strong, and insulated. It's these suburban markets that I think a lot of people just thought, oh, well, putting my house on Airbnb makes it so much easier and simpler. The barrier of entry, the user interface and interaction has been simplified in so many different ways. So Airbnb benefited and did a really smart job by removing a lot of those barriers for the average person who's maybe not traditionally an investor. They don't treat it like their everyday business or their everyday focus, but Airbnb made it easier for them to get on the platform, and Airbnb benefited, I think, from that on fees and from just increased inventory and traffic. Now, whether that's sustainable or not, I think is still to be determined, and I think we will probably see a pullback and some struggling of Airbnbs, which really probably shouldn't have been on the platform or really, that great in the first place, but were available and probably still will be available. But the Airbnb hosts are going to be the ones that are going to probably get hurt in those particular markets, suburbs.
Yeah, I think that the looming elephant in the room for Airbnb is going to be the lack of not meeting the expectation or demands of clients as a hotel of an equivalent price and star class, niceness can provide. And I think when I've stayed in Airbnbs, I still prefer to stay in a hotel.
Yeah.
Because they're staff. And I don't want the person that lives there to be there. That would be weird. But I don't mind when hotel staff are around because I know it's kind of like this accepted that this is their job, and so it's not anything I have to not worry about. So the problem for me is Airbnbs are starting to be more expensive and not live up to, I think, the amenities or the convenience that an equivalent hotel that's ran well has.
Yeah.
And I would give you an example of, we both know that there's another Airbnb style hotel near yours, but nobody's ever there. But it's different than having a technology forward thinking hotel like yours, because somebody is digitally there and somebody is working to help you and host you if there's any issues, versus, I have to call this. It's like calling your landlord.
Hopefully they answer. Hopefully they get somebody
if you're a
out.
renter, tell me when the last time when you called your landlord, you had, hey, there's an issue, and it was a smooth, easy transaction. It's like doing paperwork in the state of California. It just sucks.
I mean, I think the point that I'm getting at is, I think, to your point, if you're an investor and you're thinking about Airbnb, I would lean towards leisure markets that have year-round travel. Yeah. It's a destination for people, sun, sand, snow, mountains, not
seasonal
beach,
either. Tahoe's
whatever it may
hot
be.
And cold weather.
So thinking about good leisure markets that have year-round demand and are a destination, not just your physical property is the destination, but the surrounding area is a destination that pulls people in. Same thing with urban markets. I'd be very cautious of buying off of Airbnb numbers for a rental in suburban markets. So be cautious of that.
I can't just look at the rent?
Because I know a lot of people that underwrote their, investment and the income it's going to generate in a suburban area based on Airbnb numbers versus a midterm or a long-term, conservative number that you would get for rent. And those people are hurting. They're either liquidating the assets, they're carrying an upside down, in the red mortgage every single month. And so thinking about that, be cautious of that. Ooh, but to the other side of it, I think the people, to your point, as you said, amenities, the right customer service and the right experience on Airbnb, those individuals are going to thrive.
Agreed.
Because they're going to separate themselves from a very large sea of Airbnb hosts that aren't treating it like a business, aren't thinking about those amenities, and aren't thinking about those experiences for the customer. And those individuals are going to struggle, while the others, I think, are going to do really, really well during this time, because at the end of the day, even though travel may have some ups and downs, People still need to go have fun. They still need to play. And if you're doing it in the right leisure markets or the right urban core markets, I think with those variables in mind, you can do really well and you can crush it. That's my 2 cents. Take it to the bank, baby.
The only thing I'll add on housing right now, because I'm seeing a big surge on it, not really on Airbnb. I guess if you're buying them, right? Seller to financing, where when you do seller carry, that's really like, it was already like popular, then it got not popular. Now the interest rates are back up again. It's super popular. Somebody needs to hear this. Just because your seller will finance your deal, debt is debt to anybody that buys it. A bank looks at it as debt. Another person that buys it is debt. Do not buy a deal just because it gets approved. I've seen like 4 people come across to me that have deals that they got, and they're like, it's seller to and all this and that. And it just, I haven't ran the numbers, but I'm smart enough to know when I see a stinky piece of shit. And I'm like, there's no way that that's going to work. You're at a 9.5% rate, or excuse me, a 7.5% rate for how long? And you're going to try to make this pencil? I don't know if that's going to work, guys. So just be careful. Just because something's approved, you got to make sure your deal pencils. To Matt's point, don't run it on the best case scenario. If it pencils on a midterm at a conservative number, it's probably going to pencil in your Airbnb numbers. Be happy with that. Be happy with expecting a 5 and getting a 10. So I just want to add that in.
So this last week, Google had a big AI mishap trying to compete with, ChatGPT. A lot of the internal chatter within Google was that the CEO really rushed it. They botched the release of their AI kind of competitor to ChatGPT, which is Bard.
Bard, not Bart.
And they lost over $110 billion in market share. Is that something that investors should be worried about? Should investors be doubling down and potentially, dollar cost averaging through that dip? What are your thoughts on the overall, stock of Google. And where they're headed in the near and long-term future?
I definitely see, like, for the long term, that ad revenue, which is what really spins Google's wheels, is going to get squeezed out by competitors because they're going to be able to take market share from Google. And we're talking about Microsoft via ChatGPT. It was made clear that ChatGPT was a superior version of the product. And I agree with you. I think it's just because it was rushed. I think they came out and they said that's exactly why it's very important that you have to take your time and stuff, almost indicating that they probably rushed it.
Yep.
Do I think that's a reason to not invest in Google? No. I think just like Apple had to find its new thing from the iPod, and they went on to the iPhone, and now they're going on to other areas. You have to figure out, all growth companies eventually become value companies, or they get bought up or disband or whatever. That's where I see Apple is in its back end of being a growth company. I don't know if Google has as much. I think it's going to be like a value tech company. I think we're going to be in the next couple of years seeing like some of these companies pay dividends like Apple and start passing through more of their capital gains on the short term and the long term. I just don't know if it's a reason to get into Google, and I know it's for sure not a reason to get out of Google. I would just, if you're buying Google, and I do for a lot of my clients, I would say next time you're putting money in, Google's down, it would be a good idea to pick some up if it made sense for your portfolio. The stuff I'm still looking at, though, is like software players in the technology space, because I think software is it's kind of like, it's not correlated necessarily so much to the tech heavyweights. It's a product that anybody can use very easily, it upscales easily, and it's a very cheap. It's cheap. It has high margins. So I think software companies are going to be a big deal, and that's where we see Palantir today up 20% aftermarket because they had their first profitable quarter. And I think you're going to start seeing that a lot. I think Twilio, rest their soul, laying off another 17% of their.
I saw that 1,500 getting laid off.
Still
at
love
Twilio.
them. So the thing you can look at, though, is if you looked at how many people were hired versus how many people have been laid off, they are still net.
Pull that graph up because
Amazon's is ridiculous.
I know you sent that to me.
Yeah,
somewhere.
It's still net positive by a lot. And but we're talking like they hired 90,000 and they've laid off 30, so there's still 60,000 more workers they've hired year over year. Layoffs are going to happen. People are going to get jobs in other areas. That's indicative of the unemployment number being at 3.5%.
So we'll wrap up on these two things. Number one, for those of you who've been upset about insider trading with politicians and how successful they've been, fret no longer. As of earlier this week, you can trade the portfolios of politicians. There have been a few ETFs that have been opened. One that is live that reflects Republicans, insider trading trends, potentially those that have done really well historically and have been speculated to have done insider trading. The ticker on that ETF is CRUZ, K-R-U-Z. And of course, Democrats, no better person to represent with the ticker than N-A-N-C. Nancy, our girl Nancy. So I thought that was pretty interesting, but you had mentioned this is interesting, not too likely that it's going to stick.
So much better. Yeah, because then there's a lot of legislation that's pending to make it so politicians, and it's been bipartisan now because Nancy Pelosi's out, and a lot of the alligators are out. They're going to pass that so they can't trade individual stocks because honestly, they just want to. You can still kind of insider trade with ETFs. They're just going to do ETFs because ETFs are funds that trade like stocks. So they're still going to do it. It's just going to be less egregious because you won't buy the individual stock.
Yeah.
They're going to go in and buy, say, we can go into his 5X leveraged option ETF because right when we did it, the market went up 6%, so we made 30. It's just going to be done in a different way. But it'll be a better bad than the current bad we have.
So let's wrap it up with your thoughts on Ray Dalio.
My guy.
We all know Ray Dalio is a brilliant man and has, a very successful track record and has obviously been a very strong leader and pioneer in the financial, space for many decades. His big shtick for a long time was cash is trash, cash is trash, cash is trash, right? And he's kind of changed his tune recently. Tone, you want to pull that clip up and let's listen in on what Ray Dalio has to say about cash.
So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trashy. Cash is pretty attractive now. You've got an inverted yield curve.
Say that again. You said trash is now more attractive?
Cash
is trash, is what you used to say.
Yes, cash was negative,
right?
1.5%, 2% real rates, terrible. Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight. You lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right?
Right.
So you're seeing it reflected in not only, long duration stocks, those that didn't have cash. So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down.
So, Mr. Dalio says cash is no longer trash, that it's relatively attractive based on the current economic landscape and some of the challenges, bottlenecks, issues that we're seeing. What are your thoughts and take on that? What do you say to the people that are wondering, should I stay invested? Should I go to cash? Should I have a certain allocation of cash for opportunities that might be coming? What are your thoughts?
If you're invested, you stay invested and you keep buying because you should be getting a dividend yield close to real rates, if not higher than real rates. Unless you're just overweight in all growth stocks, then you're not going to be getting any dividend yield. I don't think I guess I'll say that I still think that too much cash is trash, but holding a slightly higher cash position, like sometimes I'm creeping up to about a 6 or a 7% cash position and then waiting on buy days to then deploy the cash. But I'm waiting to deploy the cash. I'm not holding the cash because it's got a better, relative rate compared to bonds, or the interest rate risk on it is lower, or the other points that he stated.
Right.
Cash is just dry powder, and long term, trying to time the market proves to be a fool's errand. So putting the money to work and just letting it work is ultimately the best option. If you day trade, you can time the market on day trading because you're looking over a short period of time, it's just hard to pick on Monday what's going to even happen on Thursday. It's too much time and too much stuff to happen. So for me, I'd rather just say I'll hold cash as long as I need to deploy it. I'm not saying that cash is terrible, but I still would prefer to buy equities and average down positions that are still beat up or down before they recover so that I can make more of a return on the rebound. That to me just makes more sense as a long-term bullish investor. The thing that's easy about being a bull is you don't have to, you just are a bull or you're a bear. It's when you get overly specific. You got the Robert Kiyosaki's, the Ray Dalios, because you're going to have to backtrack on it at some point because he is right. Cash does have to his points. Cash is better in my opinion. If you can get, I can get 4.7% on cash right now for a year, and I can get 4.3 to 5.5 on a corporate bond, but I have interest rate risk. So why not take away the interest rate risk and get a solid 4 to 4.5%, right?
Yep.
So to me, that's where I see he's right with his points, but I still don't think holding a heavy cash position does anybody good. I normally, for like older people or retirees, I'll use like fixed annuities as bond alternatives. So we have equity exposure and somewhat better growth than bonds, but I prefer to stay in equities if we're going to be in equities.
Yeah, I think my feedback on that, or my stance on that, is I'm going with default answer, Mr. Breedwell, all day long, which is don't pull money out, stay invested no matter what. Then the secondary piece of it is if you have capital events in other areas outside of where you're already invested, in the stock market, for example, I had some capital events in some real estate stuff. I am not feeling the pressure immediately to redeploy that cash. I'm being a little bit more cautious and looking at the overall landscape and the horizon and what kind of some of the hurdles and or opportunities currently are and future might be coming down the pipeline, and building up a little bit more of a cash, war chest. Because based on the landscape and the variables that we see, I think there is going to be some opportunity. But my default answer is I'm staying invested no matter what on my stocks. And if anything, I'm not only consistently continuing to invest based on my plan, the long-term plan that is happening year-round no matter what, I'm now considering looking at potentially ramping up some more opportunistic buys and continuing to deploy the cash on top of my plan that I'm already executing on. But I am also being considerate of, on the real estate side of things, which is my core tree trunk, that I think there's some great opportunities coming, and being a little bit more cautious and patient is a prudent discipline right now just because of the overall landscape and where we know we're at. So cash is, in my opinion, something that is really great to have a little bit more access and liquidity to when we're in a current market landscape on the real estate side of things right now. And if anything, I'm looking at ramping up and deploying more cash into what we feel is, in the long term, a discounted time to get into deploying more capital into the markets.
Yep, because you leverage and use the short-term cash for the real estate stuff, and then you use some of that cash and put it into the long-term stuff and let that work too. So yeah, I would agree with you 100%. It's never a bad time to put money in the market. I try to avoid massive lump sums, or if we get them, we try to spread them out. But people are going to be looking back over the next 5 years, and they'll talk about getting in 2022 and 2023. And be
I wish I would have put more in.
Just like they did for 2007, 2008, and like 2011.
And even in early 2020,
people are like, I don't want to miss 2000. And then 2020, oh my gosh, man. I remember people making 100% rates of return on ETFs.
Crazy.
That was a wild year.
Well, we'll keep you guys posted, and be sure to tune in every single week and catch all of these interviews on Millionaire Mindcast at YouTube. Also, millionairemindcast.com. You can check out all of the episodes and show notes there. Don't forget to subscribe on whatever podcasting platform. If you enjoy the show, all we ask, take 2 minutes, head over to iTunes, leave us a review. Any positive feedback. This is how we continue to share and spread the message with more people that are interested in participating in these money conversations. If you haven't taken advantage of your free financial x-ray, having somebody go through your investment portfolio with a fine-tooth comb, that's something Ryan and his amazing team do for free for all our Millionaire Mindcast listeners. This is one of the most comprehensive plans you're going to get, free of charge, mind you. from an amazing financial and wealth advisor and his amazing team. So you can text the word X-ray to 844-447-1555 to take advantage of that. All my accredited investors, if you're looking for syndication opportunities, passive income vehicles and opportunities, and you want to know more of what I'm rolling out in my pipeline, you can text the word deals to 844-447-1555. If you want to know more about upcoming events, you want one-on-one masterminds, one-on-one coaching, one-on-one and or group events that we have coming up, head over to millionairemindcast.com/store to check those out, or you can text the word events to 844-447-1555. If you guys aren't on my text letter, my weekly newsletter that I'm sending out, just text the word notes to that same phone number. You can check that out and subscribe over at millionairemindcast.com. That being said, keep investing in yourself and your wealth on your march to $1 million and beyond. We appreciate you guys. We'll see you guys in next week's episode. Cheers.